Let's bring on Matt Caruso from Caruso. And hey, there he is. Look at that. Matt, can you hear me?
Okay.
He hears us.
He hears us. That's
we
a good
don't
start.
we don't hear him. So Matt, sit tight while we try to hear you.
We're 50% of the way there. Half your trades work. You know, you're not doing okay. Not great.
We got into the trade. Yes, we hear you. Didn't we just hear him for a second?
Yep. We just need
yeah. Can we bump him up a little bit? Yeah, just a little bit quiet though. Maybe we can bump him up on our end, or if you can turn your mic up on your end. Very nice bookshelf, by the way. There we go.
All right.
All right, Matt Caruso, the floor is yours, sir.
Real drivers of the market. It's going to really empower you to have the patience for the proper setups and help you to really decipher from the low quality buy points and the high quality buy points. I think that's something that a lot of investors newer to the business have a hard time seeing professional investors saying, oh, it looks similar, but I don't really like this setup. And for someone who's just learning the business and learning all the different aspects of investing, you have a hard time deciphering. So I think it really comes down to what are the main drivers of the stock market. And really, these buy rules are only one part of the overall investing approach. This is kind of the core elements of every strategy. I just want to simplify it. There's really buy rules, sell rules, risk management, and portfolio management rules. We're going to focus on buy rules today and really what surrounds the actual triggering of a buy signal. But in reality, if any of these four elements are missing from your trading strategy, at some point in the market cycle, it's going to cost you a lot of money. You really need all four of these components to work cohesively, to work together in a holistic way to have really long-term success in the stock market. You could have the best buy rules. If you don't have sell rules, you won't lock in your profit. If you have poor risk management, eventually some stock's going to come around and really knock you out. And if you don't have good portfolio management rules, you're not going to maximize the returns of your entire portfolio. I mean, if you have a stock that doubles and it's 2% weighting, that doesn't really help you very much. And so it's really bringing all of these elements together to really develop high performance trading, I guess we can call it, really to do something special, to have that big outperformance, those big returns in good years, and then to be able to at least advance in poor years and not give it all back, which is just an awful experience. And trust me, I've been there. And so when you really focus on buy rules, again, you also want to get past, people just think of number 3, what triggers execution? When do I hit that buy button? But it really goes much further than that. And, you want to stop and think, well, what stocks? There's 10,000 stocks listed, I think, just about in the US. And there's international, there's ETFs. Where do I begin? Which stocks do I buy? Which market environments do I participate in? Is this an environment I should be in? Am I buying this dip? Am I looking to get undervalued purchases? Do I wait just for these strong uptrends? What defines an uptrend? And then lastly, once you can kind of put that together, then you can find your trigger. But if you just focus on number 3, the triggering, the execution side of things, that's when in good markets you can still have great performance. As if it's a hot bull market, any type of real buying technique is going to work great. The problem is when you come to choppier markets, when you come to years like 2022 or even tail end of 2021, that's where there's no more room for error. And the market does not ever really provide room for error. In bull markets, you can maybe get a little bit sloppy for a little bit period of time, but if you don't, shake yourself awake, that's going to cost you anyways. So really, before you can kind of even answer those questions, you want to ask yourself, what are the drivers of stock moves? I mean, what really makes a stock go up? And in my opinion, there's really 3 key drivers that drive stock moves. The number one most important thing is really the fundamentals of the company. I don't care what company it is. If you don't eventually turn a profit or have a path to profitability that investors believe in, the stock is not going to amount to anything. It's just going to either languish, or if they have to keep raising money, go bankrupt. So the fundamentals, and we'll take a look at actual examples of that soon. But charts don't move stocks, earnings do. The charts, although we spend so much time focusing on charts, a lot of us at least, where can I enter the stock? Where should I exit? The actual driver of that company is going to be its individual fundamentals. I mean, Amazon.com is who it is today. Same with Apple, Microsoft, because they've had this phenomenal business that churns out these incredible earnings and these incredible sales. Without that, there's really no business. The chart won't lift up a bad company. The second very important element, which some people ignore fundamentals, the vast majority of people, even professionals, will ignore what the Federal Reserve is doing. And the Federal Reserve is a private bank that administers the monetary system, and they're in charge of interest rates, setting interest rates, and overseeing banking. And the Fed really controls money and credit. This impacts everything from market trends to sector rotations. And these movements, they're not as direct, they're not as easy to understand. They're second, third order relationships. So the movement of interest rates will affect your stocks in a number of different ways. But the Federal Reserve is really the tide that lifts or sinks all boats. If there had to be one tool that I had to use to understand what are the general trend of things, or what are the prospects for the stock market and the economy in general, it's the Federal Reserve. They will, even if your stock has good fundamentals and they're profitable, the Fed has the power to end that. If you have a highly indebted company and it's profitable, but suddenly the interest on that debt increases significantly because the Federal Reserve hikes rates, well, that profitable company is no longer profitable anymore. And it goes far beyond that, because the stock market is a machine. And what oils that machine is really money and credit. That's the lifeblood, because at the end of the day, we're not buying the company. If we were going to be venture capitalists, or if we were going to be, taking over a company, okay, we can look at the actual company itself. But when you're dealing with stock, now you're at a function of what are we willing to pay for these earnings at any given point in time. And that now is going to be relative to everything else in the economy. Investors have the choice between bonds, between different stocks, between cash, between precious metals, between cryptocurrency. And so the Federal Reserve and what interest rates are doing and when earnings are going to be coming for a company will affect what people are willing to pay for the earnings of a current company, or what the expected earnings are going to be. Now, once you get all of that together, you have these great fundamentals, you have the Federal Reserve on your side. At the end of the day, who's actually going to lift that stock price? It's not going to be small retail investors. It's not going to be mom and pop. It's institutions that really will drive the stock move, the stock advance. So at the end of the day, it's crucially important. Even if you think you have a stock with great fundamentals, and you have a stock, you have an environment where the Federal Reserve is accommodative, you need to see those footprints of the institutions. And trust me, they're there. If you're Fidelity Contra fund with $130 billion under management, and you want to put 1% of your fund in a company, that's a $1.3 billion investment. That takes a lot of time to accumulate that much stock if it's a mid-cap company or lower. Maybe not for an Amazon, but if you're dealing with a $40 billion, a $20 billion, or $5 billion company, trying to invest $1 billion is a staggering amount of money. And it takes days or weeks to put on that position. And that's one fund. So imagine multiple of these funds running similar models with a similar focus, trying to accumulate stock. It's a monumental task, and their footprints are definitely going to come through. In fact, I always say the biggest advantage of the individual investor is that we can move in and out of stocks without impacting the stock price. I mean, that's huge. Institutions may have these amazing research departments with the best research in the world, and they may have even foresight as to what earnings are going to be based on ancillary data. They can look at internet trends. They can look at satellite imagery data. There's so many ways they can get information that we can't. But it's a Herculean task to have to move in and out of these companies. So the ability for most investors to say, oh, I want out of the stock, okay, hit the bid and I'm out, that's a major advantage. So if we can see the footprints of these institutions and get in as they're buying, then if we're wrong, we can limit our risk and exit. The institution doesn't have that ability to do so. So understanding when they're buying is critical, and recognizing that as an individual investor, you can exit when you want to is also a major advantage. So using all of these tools together with risk management is so critical in high performance investing. So when we dig a little deeper and we go into which stocks, and we know fundamentals determine the company value, what is a company worth? I mean, it seems like a really simple question, and that's the irony of the stock market. So many things that seem so simple actually end up being very complicated. But what is a company worth? Very similar to a bond. It's the present value of all future earnings. So okay, let's boil that down to something that doesn't sound so classroom-like. Basically, if you know exactly what a company was going to earn in the next 10 years, and then after it was going to close its doors, it'd be very easy for you to say, okay, you're going to earn X amount next year, the year after that. Given current interest rates, this is what I'm willing to pay you. And that's how a bond is calculated. No one ever argues about what a bond is worth at a given point in time. That can change day to day, but at this point in time, given interest rates, it's an absolute mathematical formula as to what that bond is worth. It's the present value of all of these future coupon payments and the return of capital. So if a company, if we were able to judge with certainty what their earnings would be in the future, it'd be as simple as calculating a bond. So we know that's what we need to do, but it's not so simple. Unlike a bond, companies are dynamic. They're changing. They're always moving. They're investing in new ideas. Their underlying clients that they're selling to are changing. The economic landscape is changing. There's no guarantee that these future earnings are going to ever come to fruition. So how do we use earnings per share? It almost seems like it's meaningless, right? Well, I like the story I always like to tell is for many years when I first started trading professionally, I was a market maker at one of the big Canadian banks, and we traded a lot of precious metal companies. And the saying in the precious metal space is that the best place to find a gold mine is next to a gold mine. And statistically, that's true. If you look at all of planet Earth and you had to dig if you had to find land to dig into, it would be just outside the boundaries of a current gold mine is the highest probability place to actually find gold. And so really, in terms of earnings per share, if we want to find, who's going to have this booming earnings, who's going to have this booming sales and surprise to the upside, it's the company that's already executing well that's most likely to do so. I mean, if there's a company that's losing, clients, they're bleeding cash, they have negative earnings, who is more likely to show another quarter of 100 that's failing, or a company that's executing strongly and is just doing fantastic? It's the company that's executing strongly that is more likely to report well. Again, they're on a key industry trend, or they have a product that's in high demand. Management is executing well. Not only do they have this high demand, but they're actually able to turn a profit doing it, which is not always so simple, as you can see with a lot of companies recently. Even if you have a great membership base, it's still difficult to actually turn a profit, depending on how your customers' preferences can change. And so even if you do all of that, and you say, okay, this company is executing so well, everything is working out, we got this very competent, smart, intelligent management, what's the risk? Well, the risk is that even if trends continue, investors can pay too much too quickly. So at the end of the day, if we overpay, it's similar to a bond. We know what this bond is worth today, but if I get so excited, I think this is the best bond in the world, which doesn't happen with bonds because there's no investor sentiment component to it, the same way, because it's more of a certainty. But if someone ran in and overpaid for a bond, I mean, they'll be guaranteed a loss. There's no real question about that. But people don't think about stocks in that way. And so they never really worry about drastically overpaying for this stock, So one of the things we have to pay attention to is, number one, that trend of earnings can fail because, the future can change. These earnings are uncertain. And two, investors may just overpay for earnings, even if those earnings do come to fruition. So that's sometimes the frustrating case where, for example, a lot of companies are still bringing in great earnings even now, and they're down 50, 60%. And people are saying, well, I don't understand what's going on. They're still making great numbers. And the thing is that people just overpaid for what was possible. And there's some other factors as well we're going to look at is with interest rates, but that's a key component that people have to always respect. And sometimes what doesn't make sense will make sense in time, but in real time, it doesn't make sense. But eventually when you finally see what kind of earnings this company will bring out 6 months, 12 months, 2 years from now. You see, oh, okay, we were paying, inadvertently, we were paying for earnings that were twice as much as they ended up delivering. Even though we thought they were good, we were actually paying for much, much more. And the more astute investors realized that and sold it down to a fair level. Let's take a look at Devon Energy, for example. It's been a very strong stock recently. And, actually, some people even question in the first place, is it really earnings that drives the company? Well, you can see the earnings line here on top of the chart, and this is the stock price underneath. I think it's fairly clear. It's not exactly perfect at every moment in time, but this is pretty much the trend of earnings is going to dictate what the trend of the stock is. Let's take another look at NVIDIA. This has been a powering stock advance. What powered it? It was those phenomenal earnings. And in fact, the only time during this entire advance we got a significant correction right here was when earnings had a slowdown. Now, I know we're having a correction as well right now, and earnings are still at the record levels. But these institutional investors, like I mentioned, they have a lot of ways to find ancillary data to kind of get ahead of what the next earnings report will be, the next 1 or 2 reports. Like I mentioned, they can use satellite imagery to check traffic. If it's a retail company, they can look at internet trends. There's a lot of different ways that they can do this. And so as great as following this trend is, it's not as simple as just saying, oh, earnings are up, let's buy the stock, because institutions, they already realize that, okay, in the future, in the next 3 to 6 months, earnings are going to slow. But what's critical here to understand is that it is earnings that's driving these moves. Now, thankfully, because those footprints of the institutions are visible on the charts, once we identify a company with these great booming earnings and we're playing this trend and we're looking for opportunities, if we suddenly see that what the chart is telling us is that institutions are now selling this company, we have a way to protect ourselves from just sitting in a company because earnings are great, and then after, we realize 6 months later they missed earnings, and the smartest guys in the room sold 6 months prior. And that's what's happened with a lot of companies right now. Let's move on to another example. This is Peloton. I mean, it's no earnings that we had this kind of mountain here in terms of stock price. But look what earnings did. The coronavirus pandemic came around, we rocketed higher. We got 3 quarters of earnings where things stayed in, and after investors realized, even though the print came out all the way down here, investors were selling in anticipation of that. They could see that the trends were failing, the trends were fading, and they sold really aggressively into the stock price. And you had a stock price fall from $160 to below $90 before that earnings report came out. And again, that's because they always have this ability to see what's going on in the future. Here's Tesla. For the longest time, we had this initial bump up in earnings where, Elon was showing that there's some future, potential future to this company. We had this nice, strong stock rise. And then we had years of no movement because earnings just couldn't get anywhere. He couldn't sustainably get the company off the ground. Even though we had one good quarter right here, institutions, again, are very astute investors, and they can tell if it's a one good quarter for whatever reason, or is it a sustainable advance? And that's really what changed in this environment right here, and why the stock went on this towering advance, is that suddenly a sustainable trend of earnings occurred. And there's 2 important elements to this. Not only do you want to see consistently climbing earnings, but you want to see record earnings, or you want to see the highest earnings for many years. And that's really where these big uptrends come. And so again, understanding what are the actual drivers of the stock market, what gets the machine to turn. And so I think the first thing we have to understand is it's earnings, or in reality, it's the anticipation of future earnings. We know what past earnings are. We can use past earnings to help judge what's the trend, and is this a company that's executing well and has the potential to keep earning well. But it's really those future earnings is what's the main driver for these stock advances. This is Square, another great example, and really pretty much followed the earnings trend line. So once you company, and we have management that's doing fantastic, earnings that are booming, estimates for future earnings are very strong. You do some channel checks, or you look online. For example, let's say it's a retail, company. I remember years ago, Lululemon was so popular, and you could, it was probably 2010, 2011 when the stock price was taking off. And I have 2 sisters. I had my girlfriend at the time, who was now my wife. Everyone was buying these Lululemon pants. It was just, you could just feel it. And so that was kind of confirming the fundamentals. But once you figure that out, what environment are you in? And really that comes down to the demand and supply of money. Money is the gasoline that drives the stock market. Again, we're investing in the stocks. We're not investing in the company. So it comes down to 2 main components. What's the cost of money? And when you figure that out, don't fight the Fed, because the Fed is what sets that cost of money. And that will be what will lift the tide or lower the tide for all of the boats and all of the stocks. that will impact, what multiple investors are willing to give to companies. That will impact how much capital is available to companies who need cash to keep sustaining or grow their business. So that really impacts the entire economy and really specifically the stock market, because if yields get high, investors don't need to invest in the stock market. If they can get a similar return without the risk of future earnings failing, if they can go in a bond or they can go somewhere else with a higher rate of return, a lot of them will take that choice. They don't want that risk. And so, the Federal Reserve, the more it increases interest rates, the more it makes stocks less appealing. And so that interest rate is just such a powerful mechanism. But let's take a look really specifically at a specific example as to how that can actually impact your stock price. So the formula that dominates everything. What is $100 next year worth today? Super simple question. I mean, it seems like, for those who took Finance 101, but even if you did learn this Finance 101, a lot of people don't realize just how important it is in the stock market. So, if you want no risk and you have no opportunity cost and you have nothing else to do with the money, you can earn 1.95% with the U.S. government. That's considered risk-free because the U.S. government can always basically print money and give it to you. And so basically that $100 next year is worth $98.10 today. And you can see right here, that's simply taking the $100, dividing it by that 1.95%, you get to that $98.10. So it's really simple. That's really the underlying formula that will dictate what those future earnings are worth for your company. If you could understand, if you can price in what are those future earnings going to be worth today, you could price your company. Now, not only can those earnings change, but that interest rate can change. And for stocks, it gets more complicated. With a government bond, it's a government bond, but let's say a company wants to raise money. It's a great economy, prospects are bright. So they go to investment banks, say, okay, we can get you debt for 5%. Fantastic. And, at that point, investors say, okay, great, this company can borrow at 5%. So this is how we're going to, estimate what this company's value is. Now, what if the economy sours and the economy's in this company's prospects sour? Well, if you're going to lend to this company, you're no longer going to ask 5%. You say, well, now your risk has gone up. So if you want to raise more capital now, that 5% is not going to be enough to justify the additional risk. You're not risk-free. You're not the government. Although in some cases, in a lot of places, the government's not risk-free either. But in that case, they're going to say, well, now instead of 5%, interest rates have gone up. So, already the Fed's raised rates. So from that government bond of 1.95 is 4% or 5. And we actually are going to have to tack on a little more than that because you're riskier. So you go from a 5% yield to a 10% yield. That dramatically changes everything. That changes what those future earnings are worth. And that also changes what kind of earnings you'll make in the future. So let's take a look. Let's take a little bit further out. What's that same $100 worth if interest rates go from that 1.95% to 5%? Well, instead of being $98.10, just that little bump up in interest rates, bring that $98.10 down to $95.20. And so that's the impact of rates changing over 1 year. Now, because a lot of these growth companies that we're looking at aren't even making much earnings right now. They're promising you, look, 5 years from now, this company in 5 years is going to be great. Actually, in 10 years, this company is the next Amazon. So we don't have a lot of earnings today, but we promise you 10 years from now, we're going to have a lot of earnings. Well, that's fine. Even if you take them at their word and they're telling the truth and they can see the future. What will a change in interest rates do to that earnings 10 years from now? So, what is $100 10 years from now worth today? Well, at 1.95%, you have to factor that money back every, sorry, this should have been 1.95, just a typo. But the answer is $82.04. But if that rates go up to 5%, that same $100 is only worth $61 because you have that 5% opportunity cost every year, compounded year after year, for 10 years. And so if I'm going to give you this money and I'm only expect these earnings 10 years from now, well, for 10 years, I could have earned 5% a year. So, by locking my money up with you, in reality, as that opportunity cost, that $100 10 years from now is really only worth $61 today. Now, let's make things a little bit worse. What if what I mentioned happens? Interest rates go up to 5%, and now we thought we were going to get $100 a share, but we only get $50 a share. What happens? Well, if we do that, we drop to $30.70. So that's how a stock that's worth $82 can crash to $30 relatively quickly with higher interest rates and a change of expectations. And so everyone's looking at all of these growth stocks saying, I just cannot believe the was worth $180 9 months ago, and now it's worth $70. Can't be. There's no reason. It can't work, or it's worth $40. It can't. It could be, because they're promising these earnings so far into the future. The Federal Reserve is raising interest rates, so interest rates for everyone has gone up. Investor sentiment has shifted. They're now wondering, are they questioning, like Peloton? Hey, you're going to take over the world of fitness. Now we're going to question that. We don't know if that's possible anymore. So you have an increase in interest rates, which over a long period of time has a big impact on what your future earnings are worth. And then after, on top of that, maybe this higher rate environment makes it a lot more expensive and difficult for you to operate. So you're going to have lower earnings as well. And now that subtle shift, that change of what Federal Reserve Chairman Jay Powell made to the interest rate curve dramatically impacted the price of your stock. So what seems so impossible is actually the right course of action. It makes a lot of sense when you understand the power of the Fed and the cost of money. That's really what drives everything. Now, take a look. I'm even talking was a growth stock environment, but that's true of the entire stock market, only maybe to a less significant degree. Let's take a look at 2018. The current environment, we know a lot of this is Fed driven at the moment, but just take a look at this chart, and the ability, you can kind of plot the tweets right on the chart, and you can see here right at the very top, Powell pledges the Fed will act with authority if inflation spikes. This sounds familiar to today, but this is in the fall of 2018. As stocks started to fall, then President Trump was complaining and criticizing Jay Powell, and the Fed pointed to more rate hikes amid the criticism of Donald Trump. And so they were really saying, we're going to keep raising interest rates. Well, the stock market doesn't like higher interest rates for all of the reasons I just mentioned. And that led to really a 20% drop in the NASDAQ relatively quickly. And when did that bull market come into 2019? When the Fed said, well, given they didn't say it, Fed speak is very different from investor speak. But the Fed said, we'll be patient with monetary policy. We'll see how the economy does. And that means, he said, Powell, we won't hesitate to tweak the balance sheet reduction if it's causing problems. That's Fed speak for, okay, we're not going to let interest rates keep rising, and we're going to adjust. We're going to adjust our path on interest rates. And that simple change of tone went from a 20% bear market to a new bull market. So that's the power of the Federal Reserve. That's the power of interest rates. Now, when you start to bring this kind of backdrop into how you're approaching the market, doesn't this have a big impact on when you're looking for buy signals? This is a candlestick chart, and there's so many classical candlestick patterns. And in uptrends, they work beautifully. It's just every single time you get this hammer, wow, we gap higher and it works great. And then in this bear market, everything fails. And people can't understand what's going on with the new investors. Well, this is what's going on. And the environment you're in is changed. The Federal Reserve sets your environment. And the fundamentals are changing because of the Federal Reserve. And stocks will respond to fundamentals. So how do you increase this investor precision? It's by understanding the real drivers of the stock market. And those are the two major drivers. So now, once we know all of this, and we've laid this out in a well-structured plan, and we're ready to do our analysis, well, when now do I actually start buying stocks? Where do I focus on? There's still 10,000 stocks. How do I know it's safe to go in the pool, even though the Federal Reserve has changed course? Because sometimes in the past, you can see in 2008, when the financial crisis happened, the Federal Reserve started to cut rates before the actual bottom happened, but it took some time for that bottom to come in. And so that final important element is that institutional investor and the footprints that they bring. So what triggers execution is the institutional buying. Until the institutions are convinced that the Federal Reserve will now be supporting the economy and that companies' fundamentals are going to improve because of falling interest rates, or at least not get any worse because of climbing interest rates, that is when it's going to be time to look for these great opportunities. And so institutionals drive the stock moves. Institutions have the best research. Institutions are forward-looking. Institutions are strong hands. They're not going to be selling their stock just because of a little wiggle in the stock chart, but the charts do show their footprints. So how do we take this knowledge? How do we actually see these footprints? Well, let's take a look. This is Shopify in 2018. And on the top chart here, we can see the S&P 500. This is that sharp drop that I just demonstrated was due to the Federal Reserve, on a path to hiking interest rates. And look at what the S&P 500 did. We fell really hard. This was the lowest it had been all year. You can look back at the rest of the chart. This broke all of the prior lows significantly. Shopify was barely breaking any lows. And actually, it was in late 2018 was still higher than where it was in April, which was significantly different from what the S&P 500 was doing. So I call that A-B relative strength. Looking at two different points in the chart, you can look at this point here on the S&P and this point here, whereas this point here on Shopify and this point here is showing a very different story. And so that relative strength, that chart of the stock not breaking lower with the market, that doesn't happen by chance. That's an institution who has a good forward view of the stock, is stepping in and putting its money where its mouth is and accumulating that stock. Because if the market's falling out of bed, that stock should fall out of bed with the market, because the market is really giving a good idea of what the general economy is going to be doing. So if that stock is not falling, specifically if it's a stock that is a growth stock, which will typically do much worse as the economy weakens for all of the reasons I just mentioned before, if that stock doesn't decline, that is screaming at you that there's something going on with that company and someone is buying those shares and is accumulating those shares. Again, you don't want to use this blindly, but you tie that in with what the Fed action was at the end of 2018, how Jay Powell changed course. If you look at the earnings line of Shopify, which was very strong, the booming earnings and sales, that's what then leads to this towering advance where you went from about $155 to $400 in only a few months. That's those life-changing moves. And that doesn't happen. I want to start with an example outside 2020 or 2021. That was a special kind of market, but these moves happen all of the time. And when you get that combination of a strong Federal Reserve, a helpful Federal Reserve rather, strong fundamentals and that relative strength in the stock chart, that's really the recipe for these really booming stock advances. Let's take a look at another example here. Let's take a look at 2020. So we looked at the earnings line before for Peloton, and this was a little bit different. Whereas Shopify in this example here wasn't falling with the market. Another way to look at that is, this did fall with the market. The market fell, and so did Peloton. But look how quick Peloton was able to get back to its old highs, and look how much lower the S&P 500 was from its old highs. So that was showing you, okay, although it did fall with the market, someone came in scooping up as much of these shares as possible, and this stock surged to new highs while the S&P was still way off of its highs. That's that very strong relative strength. And we went on to a 295% advance in only a few months. Staggering moves. And all of the elements were really there for this advance. You had an accommodative Federal Reserve, you had good fundamentals, and that stock chart was really showing that with big money was stepping in to really accumulate that stock in the face of the general market weakness. Let's take a look here at Lululemon. So again, I mentioned this earlier. I always like this example. And so it had its first, Lululemon had a couple of runs. It had a first run in the 2010 area, and after years later, after a bit of a company reshuffle and refocus, it had another strong advance. And this was 2018, early in the year. There was a lot of stock market weakness. That did not affect Lululemon, despite some pretty sizable drops here in the S&P 500. Lululemon was actually kind of advancing over that period of time, and on good earnings, we gapped up to new highs. So talk about a significant different performance relative to the general market. And again, as the market was falling on this leg here and this leg here, institutions knew this stock, well, the market's weakening, but there's no economic problem big enough to impair Lululemon's future earnings. In fact, we see them brighter and brighter. And so they're using any market weakness as an opportunity to accumulate stock. And as soon as the market weakness ended and things turned up positive, we had this 91% advance. And again, about 5 or 6 months. And very, very powerful. These are these advances that can really, really change your portfolio. It's most important because you could have a great stock move. If it's a small part of your portfolio, it won't really dramatically help you. But again, that's another part of the process. But just focusing on this element right now, these are the underlying drivers of these significant stock advances. So investors really need that holistic system. You can have all of these great buy rules. If you don't have sell rules, well, take a look at Lululemon here. After we topped, we started a very strong down move. I could bring up Peloton, as I mentioned, as a buy, and Peloton's probably a great example of a complete unraveling of the stock after it peaks, and we came down significantly lower. And so you really need your sell rules and it's not easy. It's not as simple. If you're trying to capture these big advances, you need to be able to tell, when do I want to hold on for these more significant advances, and when is it finally time to sell? Because along those advances, you're going time now to sell, you won't be able to capitalize on these big advances. One, either you'll sell too early or you'll sell way too late. And either way, you miss out on the majority of your gains. Third, risk management. You can have all of this stuff, but if you're not positioning yourself properly, or you don't have the right sell rules in terms of risk management, you risk blowing up your entire account. I mean, I think that's why I want to kind of focus on investing precision, not just another, individual buy technique today, because this environment is really showing everyone without this risk management, you won't survive in this market, not long term. The reality is anyone can make money in a bull market. Find me a professional who's been trading for 10, 15, 20 years, and that's someone who has to master all of these 4 steps, or they won't be around anymore. I've been through there myself, the boom bust phase. It's hard, it's difficult, and the best way to advance through all of these 4 different elements is that every time you make a mistake, you write down a rule. How can I improve that? What did I do wrong? Let me find a book on that subject. Let me find someone who has a complete system, so I can see how is he putting all of these pieces together. Then after, I can either use that whole system or at least understand the components of that system. And that's really how you build out all of this. The last one is portfolio management. That's really the most complex element, because now most of the time we're looking at stocks individually. You're looking at that stock chart, you're looking at its fundamentals, and you're focused on that one company. But you're in a portfolio, and you have to manage risk for the entire portfolio. Now, even if you have a great winning stock and another stock gaps down horribly on earnings, and now your whole account enters into this big drawdown, you have to say, oh, my risk appetite now is diminished because I took this beating on the stock that I wasn't expecting. There was some kind of black swan event that came out. I need to adjust my overall risk exposure, because if this other company I own then also has a similar fate, I'm going to get demolished in my account. So portfolio management, there's a lot more moving parts, tends to take more experience. But once you can also get portfolio management under control, that's when you can really maximize the entire return of your entire account. And again, that's really what matters. You could have a stock that doubles, triples, quadruples. If it's 5% of your account, that's not going to really move the needle on your entire account. Whereas if you want those triple-digit returns like I had and a lot of other people had in the 2020 U.S. Investing Championship, you need the whole portfolio to really work well. And so I want to thank you very much for this opportunity to speak here from Montreal. I wish I could have been there. Maybe next time we'll get that to happen. You can follow me at carusoinsights.com, where I have a course and I have a membership as well. And it's been a real pleasure here speaking to everyone. And I'm not sure if I can actually take questions. If I can, I'd be happy to. If not, thank you very much, everyone, for taking the time in that beautiful Las Vegas to hear my presentation.
All right, let's give Matt a round of applause, everyone.